All right, so I welcome you all once again to Target Professional Consults. The chairman for today's meeting is what? Target. Now, with all our team members on standby, please, we are going to look out for IAS 33, earnings per share. Everything to know about this standard. This standard is a performance standard. It's a reporting standard. When it says it's a reporting standard, it's for entities that are publishing their financial statements to the general public. They have to what? Include the earnings per share. So when we normally refer to as market index, and it's a requirement on the stock market. So please, if you see any public company, meaning a listed company, it is a requirement that when a listed firm prepares their financial statement, it must come with what? Earnings per share to reflect their performance. We call it performance what? Standard. What a wow. So you see, we have done asset standard plenty. Today we are doing one performance standards, and you okay. Earnings per share, we normally use it to diagnose the entity's what? Performance. And entities like future what? Development or future expansion. Earnings per share will determine your future what? Expansion. Your earnings per share will determine future expansion. The more you are earning, the more you have a growth prospect. So that's what we say we use earnings per share to assess what? Performance. Don't forget, ICA Ghana, May 2018, and then November 2021, financial reporting. May 2018 is corporate reporting. November 2021 is financial reporting. All of them, IAS 33, theory, featured inside. The rest are calculation. Now let's go. IAS 33 was originally issued in 1997 by Accounting Standard Committee, now known as what? International Accounting Standard Board. And I'll go straight to the game and discuss its objective. It's not plenty. We'll finish it just now. It talks about only 4 items. So when I list all those 4 items down, I'm done with earnings per share. So take notice and get a deeper view of the earnings per share. Now let's go straight to the game. But if you have not subscribed, please do that too. Let's go. IAS 33, International Accounting Standard number 33, earnings per share. Take notice, per share. First of all, what is the objective of this standard? Why this standard exists? Objective. So this standard only exists to just tell us how we should determine earnings per share and its relative. So it prescribes the principles for determining and presentation of earnings per share to improve performance between different entities. So please, if you are looking for a performance standard, you see, let me make it very clear for you. All the standards that we have, there are only 3. Number 1, asset standard. Number 2, liability standard. Number 3, performance standard. And every sitting, if ICA, ACCA, SIMA a certain question, they must drop questions under each of the angle. So if you know that, oh, for performance standard, this sitting, they have to bring what? IAS 33, earnings per share. You have no issue. For asset standard this year, if it is impairment, no problem. And then the rest continue. So there are 3. All the standards, there are 45 standards in all. Both IASs and IFRSs. Out of the 45 standards, we group them into 3. Asset standards, liability standard, and Performance standard. Today, I'm doing one performance. I've done a lot of asset standard with you and liability standard as well. So I'm doing performance standards today. That is earnings per share. Hope you get it very well. So let me go straight to the objective of IAS 33, the rationale, the reason why IAS 33 came into being. Take it cool. IAS 33, the objective is to prescribe. You see, objective is to what? Prescribe the principles. Third examiner, please share the link. Kindly share the link. Oh, share the link and return quickly, please. To prescribe the principles for determination. For determination. And what? For determination and presentation. I like this. Determination and presentation of earnings per share to improve performance. To improve performance of earnings per share, EPS. To improve, third examiner, performance. That's all. So one of the importance of earnings per share, we it assess performance. That's very important. So earnings per share will help us to assess what? Performance. Take notice. The earnings per share will help us to assess what? Performance of the entity or different entities. So look at this. Now, if you go on the stock market, London stock market, there are two giant stock markets in the United States. If you pick any company from there, you can compare their performance by way of using what? Earnings per share. You can use earnings per share to assess performance. And basically, that is all. So that is the objective. But here, please, there's something I want you to take notice for me. This is what I want you to take notice of. You see, you must know the principles why earnings per share exists and the determination. How do we determine it? There are three things you must know. If you know it, I won't worry you again. And these are the three things I am ringing them for you. That's all. So from here, three things you must know. Number one, the principles that underline earnings per share. Number two, the determination, that's the calculation. The determination. And then number three is the presentation. The presentation has to do with the entity, the reporting entity. Yes, take notice of this. So I want to write reporting entity, and I'm also writing entity. So that is it. And then we move on with the game. So for reporting entity, how we could what? Determine. How we could determine. So principle, determination, and presentation. You are done with IAS 33. And we move on with the game. The main focus is on the determination, please. The main focus of this standard is on the determination. How to determine earnings per share. That's the main focus. Please. Earnings per share, the main focus is on what? How to determine the earnings per share. The determination. For the reporting, forget about it. That one, it will be part of your financials. You find somewhere to put it in. The presentation, you find somewhere. And that's all. In the account, you always find somewhere to put the earnings per share. Now I'm done. Let's go to the scope. Then I'm going gradual basis for you to understand the standard itself for us. Okay. Let's go to the scope. Does it cover the scope with the earnings per share? Is a bit tricky, please. Yes. Here, the scope has to do with the entity. Take notice. Yes, we have to learn which entity are required to calculate and present earnings per share. So today we are going to learn entities that they are required by the standard to present. So take notice of that. First entity, tell the examiner that the standard shall apply to. So IAS 33 shall apply to number one, first entity on the list, separate or individual financial statement of an entity. The first thing, separate or individual financial statement of an entity. Yes. Take notice of that. Over here, whose ordinary shares are traded in public? So take notice. So we are going to give whose ordinary shares are traded in public. Ordinary shares are traded in public, locally or international. All what I'm trying to say is that the company must be a listed firm. What a wow. So that's the first rule. It can be over the counter. It can be foreign or domestic stock, please. The listing, a company can be in Ghana and can decide to be on what? London stock market. It doesn't matter. So long as it's on a stock market, whether foreign or domestic, we don't have a problem. Our problem is if you apply it and you're not a listed firm, that is where we will start querying you. So earnings per share is for who? Listed company. So that's the first rule. Okay. Let me go to the next company that can use earnings per share, the next entity. Now, number two, or the entity is in the process of filing. So entities in the process of what? Filing. So entity is in the process of filing. So the entity that files or in the process of filing to be listed. Filing to be listed. That's all. So the first rule, you must be a listed company, no problem. Or you have made an attempt to be listed, you can still go ahead. So if you have made an attempt, so imagine Target Professional Consult Limited. We are preparing to be on a stock market, on Japanese stock market, Ghana stock market, and Nigeria You shouldn't forget about Uganda's stock market. You want to be on this 4 stock market at the same time. It's allowed, it's possible. So if we are in the process, we can calculate earnings per share and showcase it in our financial statement. Don't forget that earnings per share must only be showcased or calculated if the entity is what? It's a listed or you are in the process to be listed. Simple as that. It's just one word. If you are a private entity or listed company, you can apply it for your own individual purposes, for individual access, so you can do that, but to not gain any public view. So take notice of that. Now the next entity, number 2. So that number 1 is individual financial statements. Number 2, group account, consolidated financial statement of a group. Take notice. Consolidated. So consolidated financial statement of group. Financial statement of a group. That is it. So take notice. So again, they must follow the same rule. Follow the ladder. The same rule must apply here. Listed, then the process. They are in the process to be listed. Take notice. That's the parent company. So I'm done with the scope. So in exams, take notice of that. So these are the entities that must disclose the earnings per share in their financial statement. It's a disclosure. It's also made for a disclosure standard. And then that's all. Now let me start with the recognition, the calculation and everything. So here, I'm starting with, you see, the disclosure is in the form of, here the recognition is not that important. Let's go to the measurements. That's the valuation. The measurements, I'll spend much time here. And that's all. As soon as you get, measurement is a calculation. How to calculate it. Basically, this standard is all about the calculation. For the disclosure and presentation, it's just one way of presenting. So we look at that and we move with the game. All right, with that. Now let's go. First, earnings per share. Please, in a subsequent write-up, I will refer it as what? EPS. EPS. That's all. So here to calculate EPS, the basic formula, EPS is nothing but, it's not the earnings ordinary. Earnings over, right. It should be earnings over number of shares. That's all. But there are so many types of earnings, and there are so many types of what? Of number of shares. Here, the shares should be ordinary shares. Take notice. Ordinary shares. No preference shares. We are begging you. Don't come and tell us that every share be shared. So you're adding preference shares in addition, please. They are demarcations. They are demarcations, so we are begging you. Not like that. Every share no be shared. They are all strict demarcations. You are interested. Here, earnings per share refers to the earnings attributable to equity holders, ordinary shareholders, the parent shareholders. And then that is it. Okay. The next one that we can talk about is, now there are two reporting entities. So it gives two different formulas for earnings per share. Separate financial statement and a group. So let me do the separate for you. So for separate entity, for individual entity, not a group, earnings per share is now equal to antipart profit after tax minus irredeemable preference dividend. All divided by 1/2 weighted average number of shares, aka 1/2. So for individual financial statement, that should be the straight formula that we have to use. So this is the formula we are going to use for the individual financial statement. And then we move on with the rest of the story. Please, earnings per share is due for examination. No. It's due for examination. No. Level 2 and level 3. Take notice of that. It's due. So let's continue. Now, what about a group? So this is a formula for individual. For group, account, earnings per share is equal to the profit after tax for the entire group minus NCI share of profit, NCI's profit minus irredeemable preference dividend. Again, all divided by the weighted average number of shares. Yeah, of the parent, only the parent. Yes, weighted average number of shares of the parent. Don't add all the subsidy shares to it, please. We are begging you. Even though we are arguing that it is for the group. So that's the first issue. So I'm done. So let me test our pause more and see how best we can calculate earnings per share with this little question. So let me pick my little question. I always call it little question, but it's not little. All right, so let me project this material. Please, as soon as you register with us, you have free access to all this material. And don't forget our digital library. Yes, I'll introduce you to our digital library. As soon as you register with us, you have access, free access to our digital library. So let me probably walk you through after the class, I'll walk you through how the digital library works. We have all the lecture materials, including books, lecture notes, all the questions that we use, together with the past questions, question banks, solved one, and unsolved one as well. Take notice of the game. So this one contains IAS 32, 33, 36, and IFRS 5. All these are in one package. So let me go to IAS 33. I have a very nice question in here for you. Good, earnings per share. My first illustration looks super. All right, so we are going to solve this one before I continue with the game. So this is financial statement of a group of a company. So this is the total profit, 20,000 for the entire group. And then the owners of parents, they have 18,000. NCI share of profit is 2,000. And these are the dividend they paid. And additional information, dividend presented in the statement of change in equity on irredeemable preference shares, 4,000. Ordinary shares, 6,000, no problem. Weighted average number of shares as at the end of the financial year is 60,000, no problem. Calculate the basic earnings per share. Good. So let's go straight to the solution. This is a very basic illustration before I now tackle the main situation. So first of all, I've quoted a formula here. So example 1. Basic earnings per share should be equal to what's the profit after tax for the entire group? Profit after tax for the entire group is 20,000. So to be 20,000 minus NCI's share of profit. The NCI share of profit is, let me pick it. Probably you can take a screenshot of the question when it comes. NCI share is 2,000, non-controlling interest is 2,000. Here we want earnings that is attributable to the owners, equity holders, not any non-controlling. And this profit 20,000 is for the entire group. So we are interested in the portion that belongs to the parent only. If the entire group earn 20,000, NCI 2,000, parents will earn what? 18,000. So shortcut only. You could have just picked the 18,000 to save yourself. You see, this gives us 18, so you could have just picked the 18,000 and save yourself. Minus irredeemable preference dividend. And I'll explain why we subtract irredeemable preference dividend. Irredeemable preference dividend is 4,000. Please take note to it must be irredeemable preference dividend, not the redeemable. I'll explain why it's like that. So minus 4,000, all this divided by the weighted average number of shares, that's ones, and that's 60,000. So at the end of the day, what do you get at your final answer? Mathematicians, help us. Mathematicians, when you divide 14,000 divided by 60.
0.23.
All right, so that'll be 0.23. Now, 0.23 like this. It will be Ghana cedis per share. However, for purpose of your exams, the examiner will mark it for you. In reality, earnings per share must be quoted in the decimals. So it must be quoted in pesos, cents, and pence, and the rest. So if you're in Ghana, this should be quoted 23p or 23.00p. Take notice, that is how we quote earnings per share. If it's in dollars, it must be 23 cents. If it's in pounds, 23 pence. 23 pence. Then you move on with the storyline. That is in reality, if you are publishing your financials. So, Mr. Accountant, please take notice of this in reality so that we don't do things otherwise. I'm done. Please, your exam question will not be easy like this. So. Your exam question will not be easy like this. So take notice of that. No. Now let's go to slowly the main issues. Now let's start from earnings per share of an individual. Now let me explain why are we subtracting, why subtracting irredeemable preference dividend. Irredeemable preference dividend. You see, don't forget that we are earnings per share is earnings attributable to equity. Take notice, equities or ordinary share equity or ordinary shareholders only. Equity or what? Ordinary shareholders only. So take notice of that. Equity or what? Ordinary shareholders only. So if the profit contains profit that is attributable to other members, it must be subtracted. So, but irredeemable preference dividend is yet to be subtracted. But let me make it clear for you. Take notice of this. Preference shares, it can be a liability, it can be an asset. Sorry, equity. Preference shares, there are two types of preference shares. Take notice of this. We have the redeemable preference shares. This one, if you understand this, you'll be fine. Take notice of this. So, irredeemable preferences. This is straight up. It's a non-current liability, third examiner, a non-current liability. This is equity. So the dividend paid on this is under finance cost. So the dividend paid over here is in changes in equity. Yes. If I should go further, let me go further. Who has the option to redeem? Option to redeem. I just want to go further. If it's with the holder and then the issuer, this one, when we do IAS 33, IAS 32, and IFRS 9, you understand this into deeper detail. Or watch any of Target Professional Consult video on financial instruments. This has been explained. We call it special case of preferences. We call it special case of preferences. That's the name we call it. Now, if the option to redeem is with the holder, then it's a liability. It's a non-current liability. If it's the issuer, it's an equity. Let's make this clear here. Now, all dividend paid on debts are finance costs, true or false? Yes. All dividend paid on redeemable preference shares are what? Finance costs. That's true. But all dividend paid on irredeemable preference shares are under equity, under changes in equity. So tell me these two figures, these two dividends. Now tell me these two dividends, which of them will be subtracted before arriving at the profit after tax? So the profit after tax, two dividends, which of them is yet to be subtracted? That is the dividend on redeemable preferences, which is the same as finance cost, or dividend on irredeemable, which will be in changes in equity. So which of these have been subtracted already? The dividend on the redeemable preferences. So in that case, we are yet to subtract the dividend on irredeemable preferences, and hence it becomes what? That is why we have to what? Subtract. So the earnings, good. The dividend on the redeemable preferences has been subtracted already. Take notice. This one is a finance cost, so they've subtracted it already. But the dividend on irredeemable preference shares, it is never finance cost. So that is why we take it off, so that we can now know the entire earnings attributable to the real owners. Don't forget, irredeemable preference shareholders are not real owner. Irredeemable preference shareholders are not real owner, please. We are talking about the real owners, ordinary shareholders. They are the real owners. So earnings, we are interested in profit that is available to what? The real owners, not the side chicks or the side owners. So you see, somewhere 2018, someone proposed IAS statistics accounting for girlfriends and side chicks. No problem. Over here, we are interested in what? So they can apply earnings per share. Yes. So preference shareholders are called side chicks. whilst ordinary shareholders are what? The main. So here we are interested in the earnings available to what? The main owner. So after taking all the side chicks money, whatever left. So that is why we pick the profits and we'll try as much as possible to reduce it by the earnings that is for other team. That is the preference shareholders. So I'm done with the game. I'm now going to introduce you to earnings per share and it's related. By the way, by the time we finish this discussion, you must know the importance and then the disadvantage of earnings per share. So let me do it for you here. Fill in the empty space. Tell me the purpose, the importance, and the limitations. So tell me, at least give me 1, 2, 3, 4, 5 points. That is your trial work from our discussion. Importance of earnings per share. This one came May 2018, ICA corporate reporting level 3. Question number 2A. This one came IFRS financial reporting, November 2021. What a while. So all these are what? Examination questions. ACCA June 2015, Advanced Audit and Assurance, Audit Procedure or Audit Methodology on earnings per share also dropped. So all angle, all weather. Yes, this one is more than winners win, winners take all. So now let me start with the main game. Maybe getting to the end of the storyline, I'll come and fill the potholes for you. I have talked about a lot of the importance. Now let me start with them. For individual entities, so I'm going to do with the individual entities. For the final level, expect group, and for financial reporting, expect individual entities. Individual entity. Again, for final level, there's 2 things you must know under earnings per share. So as when we are moving on, I'll be explaining where financial reporting ends, where corporate reporting, and then the final level also pick it from. But please, for the final level, you must know everything. Now let me I'm going to set a build-up question to explain everything to you. First, let's take this. Now, try out. Let's just assume for individual entities, in fact, there are 3 things. Let me make it clear here. 3 things that affect earnings per share. The 3 things before, 3 issues that affect earnings per share. So in exams, look for this. Number 1 is issue of new shares at a full market price. What a wow. Number 2, bonus shares issue. Bonus shares issue. And the last one is right issue. So I'll take the next few minutes and describe how you should do the computation. Right issue. That's all. So take notice of that. So now let me start proper. So try out. Imagine this is 2019 and 2020. Profit after tax for the year, $50,000. And this is $70,000. Now let's go. Number of shares, please. This question is a build-up question. Join the hands, all of us. We are setting the question together and solving it. You see, by the time we finish setting this question together and we solve it, you see how examiners suffer before they set the question. It's not easy. It's not easy at all. And it's not so easy to answer a question. So examiners are suffering, longer students are also suffering. Why can't us agree so that we can only swear affidavit at the law court that you understand whatever I've taught tonight? No examination, come for the certificates. The world will be very interesting, no stress. All right, so it won't be like that. So let's go. Number of shares. Let's just assume the number of shares is 100,000 shares. That is as at the end of the year. So let's just assume this question, I'm developing it. So as and when I develop a part, I go and solve in that order. Now let's just assume I'm treating the issue of shares at full market price. Somewhere in, let's say April, 1st of April, 2020, 50,000 ordinary shares were issued at a full market price. Please, under exam conditions, you don't need the price. There's no need for the examiner to tell you that it was issued at $20 per share, please. It is not needed. Even if they give it to you, forget about it. Unless the number of shares have not been given to you, fine. So long as they have given you the number of shares, we don't need the market price. We just need the information as to whether it was a full. That's all. So I'm done. Prepare the earnings per share for both years. So here, if I put $150,000, sorry, 150,000 shares here. This is note 1. So let me go to the other side. So I'm solving it here. Solution. Only the issue. First question. The number 1. So for 2019 and 2020, quote the formula. Tell the examiner that earnings per share is nothing but antipart over 1. In this question, there's no irredeemable preference dividend. So forget about that issue that we said, irredeemable preference dividend matter. It's only when it exists in the question. That is where we give reference to. If it's not there, we don't do anything. Let's take notice of that. So here, code the formula, substitute. We are just starting from the basic to the deepest portion of the standard. So over here, the number of shares is 50,000. Sorry, the profit after tax is $50,000. divided by 100,000 shares, in which you will get what? 50 cents. 50 cents or 0.5 pesos or 0.5 cent dollars. 0.5. It should be 0.5 what? Dollars or 50 cents. Now, but for 2020, you do like this. $70,000, we have to look for the weighted average number of shares in 2020. So let's go and do workings. And I want everyone's attention must be here. Synergy, I want your attention here. We must know how to calculate weighted average number of shares. There are so many ways, so many formulas in so many books. Let me introduce you to the simplest of all so that we follow. All the formulas we are going to use is the most simplified one so that it will make the learning very easy. So watch carefully how we are going to calculate the weighted average number of shares. You see, if all the shares, not all the shares contribute to profit, the standard says that we must weight the average at the end of the reporting period. Why do we weight average? Because look at the show. After the year starts, there is 100,000 shares. Along the line, they issue additional 50,000. So therefore, the shares outstanding at the end of the year was 150. But let me ask you, this 150,000 shares, this 150,000 shares, do we publish? Did all of them exist throughout the year? Did all exist throughout the year? No. 50,000 came in late. So we must weight the average of the 50,000. 100,000 was there throughout the year. So that is the essence of the weighting. So anytime you issue shares at a full market price, not at the beginning of the year, but in the mid-year, like this one, April, middle, June, July, August, then it means that you must wait average. Please, their financial year ends at 31st December. Financial year ends at 31st December. So let's take notice of that. Now let's go. So now let's go and weight the average. So tell the examiner, calculation of weighted average number of shares. One is draw a table. In the table, put date. And table start with the date. Very important. Code the date carefully. Second, please decide. Then write the weighted average number of shares. One is. It's a very nice table. The table starts from date. So much. Right here, the narration, detail. Right here, number of shares. Right here, the weight. Then write here weighted average number of shares. What a wow. Follow this. As soon as you get this format right, earnings per share will not be a problem again. You see that we did not weight the average of these 100,000 shares. No, because they didn't issue any new shares during the year. But for 2020, because they issue new shares, we must find the weighted average. Not all the shares contributed to profit. Take notice. If you issue shares at the middle of the year, not all of that shares might not contribute to profit fully. So take notice that that share might not contribute to what? Profit fully. So that is that. And we move with the game. So you must weight the average. How then do you start? Start. The year will start from 1st of January 2019. Balance brought down. How many shares were there at the start of the year? 100,000 shares. 100,000 shares were there at the start of the year. Now ask yourself the most simplest question ever. From the beginning of the year, from these dates up to the end of the year, how many months? So the weight will be 12. So it will be 12 months out of 12 months. Hence, it will be 12 over 12. Hence, full year. To get a weighted average, multiply the number of shares by the weight. Please, 12 over 12 simple means 1. Don't even waste your time and weight shares that were there at the beginning of the year. Don't waste your time to weight it. Because all the shares that were there at the beginning of the year travel to the end as well. So they will take full number, 100,000 shares. Follow. Then along the line, step by step, note 1 says that April, somewhere April 2020, 50,000 ordinary shares were issued at a full market price. So that 50,000, code the date, 1st of April 20, in fact, this one's supposed to be 2020. You take notice of that. It's supposed to be 2020. Why 2020? Because this 2020 issue. For 2019, we are done. We don't have a problem with it. So here, 2020 should be 2020. Third examiner, issue of shares at what? Full market price. How many shares came in? 50,000 shares. Please, from 1st April up to the year end, how many months will the shares contribute to profit?
9.
All right, so 9 months, from April to December. So these shares will only contribute to 9-month profit, not the 12-month profit. That is why we are weighting the average. The rationale is that the share did not arrive at the initial date. It came in when some portion of the profit has been what? Made already. So take 9 months out of 12 months or 50,000, and that is all. So 50,000 times 9 over 12. The answer will be
37,500.
All right, so we'll take that. So basically, you get that particular answer. So that will be 37,500 shares. So in simplest language, the weighted average number of shares should be 137,500. So actually, even though they have 150 shares outstanding, not all of them contributed to profit. So out of the 150,000 ordinary shares, only 137,500 contributed to profit. That is why we must wait. That is the essence of the waiting, because not all shares you see contributed to the profit. So you must wait to the average. Now we are done with the story. So to be 137,500 shares. So what will be the answer? And then we move on with the game. Now, if we divide this carefully, that's 70,000.
51 cents.
Good. So that will be 51. Over here, if they have decimals, we have to bring the decimal. We have to run to 2 decimal places. 2 decimal places. So it is 50 points. It was the original answer is dollar
0.51.
509 is here and 1. Or you have to write it this way: 50.91 cents, or in shortest language, 51 cents. We agree. So that is the stock market quotation. So 50.1 cents, you are free to go, or 0.509 cents. Please, all of them, we have per share. Write per share against it. Write per share against it. All right, so what if? What if? So try your hands on this in the next 5 minutes and type me. I want the person that will finish fast. I'm looking for the fastest person. So start your calculation. What if this time around the number of shares is 25,000 shares that were issued? Let's look for the fastest person. Don't forget, overspeed kills the fastest rat. So imagine it's 25,000. What do you think will happen? So if it is 25,000, the same storyline. So within the next 2 minutes, do the computation and tell me your answer. The next 2 minutes, that's 120 seconds. Just type your answer down. And all of us will confirm that. All of us will confirm that together. Wow, someone has finished. Wow, well done. Well done. Well done. Well done. So if that's the case, then it means I have to now clean this side, clean this one, clean this one, clean this one, clean this one, clean this one. Everything remains the same. So what do you get? Wow, 0.589 per share. It is right until the final marking scheme is reviewed. That's so true. That is so correct until the final marking scheme is reviewed. Okay, so let's put 25,000 shares here. Multiply by 9 months out of 12. So 9 months simply means 75%. So that 75 times 25,000. So that will give us 18,750. Now, if they put it all together, I get 118,750. Wow, what an interesting paper. That's all. You are done. Then you do the final computation on the calculator. Do the final computation on the calculator. Then move on. Please make sure that I get a stable internet to follow all this calculation. Yes, because I'll be going deeper. If you understand this one, the next one will be a little bit advanced, much more than this. Now, so let me do the computation. $70,000 divided by 118,750. So I'm getting something like 0.589 5 or 58.95 cents. Good. So which year would they be doing well? Which year? So basically 2020, they are doing well, no problem. Now I'm done with issue of shares at a full market price. Now, let me confuse more. Yes, this one, within the next just 60 seconds, you are solving this using 60 seconds. What if the shares were issued on 1st January 2020 and they issued 25,000 shares? Not as stated 1st April, no. What if it's 1st January 2020? I just want you to understand certain things fully. And I'll make sure that we treat all aspects of what the earnings per share. Okay, so you have 45 seconds more. Wow. You are done. 56 cents. Wow. More answer. 56. Okay. Wow. More answers. You still have some 30 seconds to go. Wow. Seems like you can solve a question under 30 seconds. 15 seconds more. Everybody should try your please. Try and answer it. 50 cents. 56 cents. Okay. So you see, the trick of the matter is that once the shares were issued at the beginning of the year, there's no need for us to wait it. So in that case, it will still be what? Yes. In that case, it will still be 125,000 shares. Now, there's no need for us to wait it. Both the weighted average and number of shares will be the same because from the beginning to the end is still what? 12 months. So in that case, we just have to divide 70,000 by 125,000. That's all. That is all what we are trying to say. That's the storyline. So 70,000 divided by 125. Yes, 56 cents, correct. Okay, so I'm done. Now let's move on to the next aspect. Now I am going to bonus issue. Bonus, so I'm down with full market price. That's all. IAS 33 earnings per share talks about 4 items. 1, 2, 3, 4. And I'm down with 1, 11 with 3. I'll finish with these 3 right now. Then left the last one. That's all for IAS what? 33 earnings per share. And so long as it's due for examination, next sitting, September ACC exams, December ACC exams, November ICA Ghana exams. I have to see the word earnings per share in it before my heart will settle down. Do you get that? Yes. So let's go. Now let's go to bonus issue. You're welcome. What is bonus issue? You see, bonus issue, normally we issue shares for free. That's all. So when you say bonus issue, shares that are issued for free, normally to existing shareholders. If anybody can partake in a bonus share issue, target, I own shares in all the companies that exist on this set. You know why? Anytime they are issuing bonus share, they say it's free. So I'll just go and subscribe. So bonus shares are shares that are issued to existing shareholders. They are free. We normally call it deemed dividend. In taxation, in advanced taxation, we call it what? Deemed dividend. Why do we call it deemed dividend? Let me explain. Sometimes the company wish to declare dividend, wish to pay dividend, but the cash, the money is not there to pay. If money is a problem, but our performance, we have enough profit. The company have made enough profit, billions of profit, and they still have the capacity to pay. But the means is not there. The means at which the fiscal cash, the check, the bank, the money is not there. Fiscal money is not there. Then what do? Okay. Then why can't we give the shareholders additional shares for free so that their value will increase? That's all. So anytime company don't want to pay dividend, usually the best option or the first option that comes into mind is to give us what? Bonus issue, deemed dividend in taxation. Now let's go to the game. Now for bonus share, we always assume that wherever, this one you have to use red pen to write this. Please use red pen to write it. Wherever you stand to issue bonus shares, we assume that the bonus shares were there at the start of the year. What a wow. Irrespective of wherever you issue the shares. If you like, issue the shares at January, June, August, September. We assume that those shares were there at the start of the year. In that case, we don't weight bonus shares. So in several books, usually see them giving us instruction that we don't weight bonus shares. Yes, we don't weight. The reason is that there's an assumption. We always assume that the bonus share was there at the start of the year. If that assumption is not valid, then we have to weight bonus. That is why always that assumption will be there. Good. So let's just give an example. So somewhere, so I'm continue. This question is a build question. No two. On 10th of July, on 10th of July, 2020, the entity made 1 for 4 bonus issue. That's all. Full stop. 1 for 4. So here we have to calculate the number of shares that were issued. So we have to calculate the number of shares that were issued. What's the number of shares that were issued? So that's the first thing. So we are going to continue the storyline. So have you seen, I am building up the question. So I'm now going to solve everything here together with the bonus issue. It's a build up question. Let me solve that one here. Solution to the 2. I hope you are following. Please, I hope you are not confused. Solution to the 2. But you are not confused. Now, the very first one that we'll talk about is to still talk about our 2019 and 2020. Basic earnings per share is equal to, the more I code the formula, the more I remember. So the more I code the formula, earnings per share is equal to antipart over the weighted average number of shares. Still, in 2019, the earnings after tax is $50,000. Number of shares is still 100,000 shares. It gave us dollar of 0.5 or 50 cents per share. What about 2020? 2020, we have a dollar of 50,000. We don't know the weighted average number of shares, so let's go and calculate it here. So we are going to calculate weighted average number of what? Shares. This time, right, include bonus. Take notice. I have magically added bonus to it. So magically, I have added bonus to it. So take notice of the earnings per share. So look at how you're going to do the bonus. That's where the focus should be. Start by telling us dates. Right after your dates, relax. Come back again and write your detail or narration or particulars. Write your number of shares. Please share the link. This is virtually free class that you can enjoy. Please let everybody join. Tell a friend, tell another friend. Don't forget, exactly next week, we are starting the main tutorials. Register to have access to all the lecture materials and the books. Right after the number of shares, we move on to what you call the weight. That's where the issue is. Right after the weight, you now tell the examiner weighted average number of shares. What is? All what you need to do is check the date, 1st of January, 2020. That's the balance brought down. The number of shares outstanding was 100,000 shares. We said the weight should be 12 over 12. So hence they'll get 100,000. On 1st of April, 2020, I'm only copying the first table. We'll get the same answer. The company issue shares at full market price. And the number of shares was 25,000 shares. Hence, the weight was 9 out of 12. We had 18,750. Please, this one is normal. No issue. Then let's bring the bonus.
It was 50,000 or not 25.
All right, so I'm using the updated question. This one, I updated it. I produced 2 different questions and solved them at the same time. Okay, that means that this side have to be 125. Now, initially it was 50. And later on, I even made you to solve it using 25. I want the 25, not the 50,000. Agreed. I hope everyone agree. And that's the solution for this. Yeah. This 25,000, and that's the solution. Now let's go to the bonus. Check the date careful. On 10th of July, for bonus, if you like, they should issue the bonus on 31st of December, 2020. It doesn't matter. If like they should issue that 1st of January, 2020, it doesn't matter. Wherever issue the bonus, we don't care. We don't care because we don't weight it. We assume that the bonus was there at the start of the year. So you just forget about the bonus date. Calculate the number of shares that will come in. When you see 1 for 4, it means that 1 new shares for every 4 existing shares. 4 existing shares. So as at the time, as at 10th of July, how many shares was there? So number of shares in existence as at 10th of July. You can tell us already they started the year with 100,000 shares. Along the line in April, they made 25. So now they have 125. So take notice of that. Just a second, friends online. All right, so take notice. Please do not assume that because we make a very bold assumption that the bonus shares exist at the start, so the calculation must be on the 100,000. That will be a very slightest mistake, unless the examiner instructed you to do so. So it must be the number of shares at the date of the issue, not at the start. So the bonus shares should be applied to the number of shares at the time we issue the shares. And you can get it here. Let me show you where you can get it. You see, you can get it here. Add this one, it's 125. So the bonus shares will be applied on this, not on this 100,000 alone. So 1 for 4, how many shares will you get? So 1 for 4, always do like this. The new should be on top, existing or the old. O should be down times the entire existing shares or existing shares. Over it to be 1 over 4 times 125. Please, what do you get? Answer. 31,250. What a wow. 31,250 shares. Done. 31,250,000 shares. Okay. Now 31,250 shares. Yes. So you come and put it in nicely. Write the date careful. 10th of what? July 2020. Write here bonus issue. And write the number of shares. 31,000. Let me go and copy one more time. 31,250. 31,250. I like this question. Wow. Wow. 31,250. Now, what will be the weight? We assume that the bonus was there right at the start. Even though the calculation of the bonus will always be on the number of shares at the time you are issuing. But the assumption is that we deem to be there at the start. So hence, what will be the weighted average? It will still be the same. We don't weight bonus. Don't waste your time. Bonus shares and open balances, we don't weight them. Don't waste your precious time to weight bonus and open balance shares. You only weight shares that were issued at a full market price. That's the only shares that we weight. Apart from that, we don't weight any shares again. This is the storyline. In fact, this is what you need in the exams. Now put all of them together for me. Find the total number of shares here. 150,000 shares. What a wow. Yes, 150,000 shares. This one is 100 and, what did it be, 150? What about this side too? We must calculate this side too. That will be the total number of shares. Give me the number of shares, the total. And we move. 125,000 plus 31,250. So 156,250. Confirm for me that the answer is correct. Hence, let's put them in and complete the story. So to complete the story, let's divide 70,000 by $150, 150,000 shares. So let's complete the story for me. Let's all complete the story and we move with the game. So 70,000 divided by 150. Now let's go. And please don't go. I'm going to review certain issues for you. So it will be dollar of, what do you get? 0.4667 or 46.67 cents. All of them per share. Did you all agree? Good. So 47 cents, I'll take that. Now, if you have a question, kindly ask before I ask my question. Don't forget there are 4 things you must know tonight. And we are done with 2. 11 just 2, we are done with any special forever. There's no issue again. What 11 is the advantages and disadvantages, if you like. Check all the examination questions. It will be centered on the 4 that we are doing, on the 4 issues. All exams questions are centered on the 4, together with the theory. So grab it for us. Now, if you have a question, can you ask or put them in the comment section before I keep in with my last question, with my question. If you have a question, can you ask, what is the 4th issue? Yes, the 4th issue, that one is different. It's on its own. So apart from these 3, the 4th one is on its own. That is why I've not added it to this. This one calls what you call basic earnings per share. The 4th one is dilution. So we have diluted earnings per share. That's the 4th issue. This is basic earnings per share. Everything we are doing here is called basic earnings per share. Then the last one we'll learn is diluted earnings per share. Right after that, that's all. And we'll have what you call anti-dilution. Diluted earnings per share and then anti-dilution. All right, so I'm done with the storyline. Let me clean this side. Now let me ask my question. Please, let us be very honest. I'm going to ask a very honest question. There's something that a lot of people state. There's something that you see it in the books. This is a real storyline. This is the reason behind, the understanding behind. Please, I want our team online. Please, check your internet. Don't go. Looking at this earnings per share, 2019 and 2020, which year are they doing well? Because we said that earnings per share, the main purpose of earnings per share is to do what? Is to determine performance. Earnings per share to determine what? Performance. So which year have they performed well? Tell us. Based on this, can you let me hear your comments, please? Which year have they done well? Is it 2020 or 2019? 2020 or 2019? Which year have they done well? So tell me, looking at earnings of 50 pesos against 46, which one is so good? Let us be honest. Say the truth. 50. I want everybody's answer, please. Everybody, I want your answer. We are a lot. So please, even if I drive in park and then tell me the answer and continue driving. Now let's go. Because I want to see everybody's answer. Which year are they doing well? Tell us. Yes. On the face of the pin sheet, it's clearly 2019, but it is not 2019. 2019, they've not done well. Let me review a secret, a top secret to you. Look, check something careful here. Why is it that in 2019, they made a profit of 50,000? 2020, they made a profit of 70,000. And yet you are still telling us that because of earnings per share, they have performed bad. So there are certain things that if we don't adjust, it won't speak the truth. So here, there was something, we call it, anytime there's bonus issue, take notice, anytime there is a bonus issue, comma, the profits is distorted. And it's not a very good. We don't use that one to determine performance. We don't use the earnings per share again, you see, unless we adjust due to non-weighting of the bonus issue. And hence, we cannot compare the earnings per share with bonus issue without the earnings per share with bonus. You can't compare. So here you can't compare. So I just asked so you can't compare because the situation that took place in 2020, there was a bonus, no bonus, so you can't compare. Please take note. 2019, no bonus issue. 2020, yes, there's bonus issue. You can't compare the earnings per share. Please take notice. It is haram. It is forbidden for you to do that. So because of that, if you go to Nigeria, they call it what? Buko haram. Book is haram. Those with pen, they steal more than those without pen. Those who know book, they steal more than those without book. Yes, that's the genesis. Now let's continue. So how then do we compare? So anytime there's a bonus issue, the examiner will ask you to produce a comparative earnings per share. So I'm now going to produce what you call a comparative earnings per share. Comparative earnings per share. We will calculate it for 2020. And that is what we can compare it with 2019. So in that case, please, help you understand where we are coming from. You can compare situations that have a different basis. Situations that differ in terms of basis, please, you can compare. So here, what do? So we are going to recalculate a new earnings per share. That one we can compare. So we call it comparative earnings per share. What a wow. What a name. Comparative earnings per share. So anytime, let me give you a secret. You see, if you go to examination, ACC and ICA and SEMA, when they set the question, see the word is earnings per share, and you see, and calculate comparative earnings per share, it tells you clearly there's a bonus issue in a question. So let's look for it. That's all. If there's no bonus issue, there's no need for you to calculate comparative earnings per share. We don't need it. Comparative earnings per share only comes in when there is iota of what? Bonus issue. So let's go. How do you calculate it? Let me give you the formula. There's a critical formulas. There's a lot of fractions. Please, some books use fractions and co. Please, they are right. But why the bonus issue becomes multiple times in a year, it creates a little bit of confusion. So go by this simplified version and be free. Now, what is the simplified version? This is a simplified version. Pick. Now, here and there, the comparative earnings per share, we have to calculate for. I've made certain things clear for you. We are going to calculate for 2019, but we are going to compare it with 2020. Let me make it clear. We calculate for 2019, but we are going to compare it with 2020. All what we are going to do is that assume that the bonus share also exists in 2019. That's all. Let me even provide more insight. Just assume. So anytime you are calculating comparative earnings share, what do? Just assume, please. You can't afford to miss this section. From this section going, we are now entering into deeper waters. So now, just assume. Just assume that the bonus share exists in 2019 as well. And recalculate the earnings per share in 2019. Recalculate. What a wow. What a wow. You see how nice the story look like? Just assume that the bonus share exists in 2019 as well. And do what? Recalculate. Recalculate the earnings per share again. That's all. So let's go. So even though it's for 2019, so the formula will be profit after tax all over the number of shares now plus the bonus issue. That's all. So now let's go. So tell me 2019 profit after tax. What is the 2019 profit after tax? Anyone to tell me? 2019 profit after tax is $50,000. Bring it. Because that is what it produced, this 50 cents. So that will be $50,000 all divided by the number of shares after 2019 is 100,000. How many bonus issues were made? So go to your table, the bonus shares. What's the share? What's the bonus share? 31,250. Assume that this 31,250 also exists in 2019. So therefore now they will have the same basis. You can never compare things of different bases. Please, it's not a good thing. Never and never compare things of different bases. It won't give a good judgment. So plus the bonus of 31,250. So what do you get? Final answer. I need a final answer. So that would be 50,000, 1, 2, 3 divided by 131,250. I like that. So now the answer will be, I like the answer. It has made the study very interesting. 0.3810 or 38.10 cents per share. Now, this is the earnings per share that you can compare. So if you want to compare, now let's compare. 2019 comparative earnings per share is 38 cents. 2020 is 47 cents. Now, which year are they doing well? Which year have they performed well? Tell me the truth now. Now, which year have they done well? Which year the performance has been improved? Now, tell us the truth. 2020. So have you seen earlier, you made a statement that 2019 was the best year. But in actual sense, it wasn't best. It's because the bonus has not been taking effect. You see, bonus issue always distorts profit. It worries profit. So take notice of that. We are going deeper. Yes. We are going deeper. And this is for level 3, level 2, all levels, all weather. Now I'm done. Let me go and pick the last section over here.